What's up, guys? It's Randy Hatada here at Xpand Realty, and we have a special guest and a special topic today. And this podcast is going to be specific to investors or anyone who wants to invest in real estate and learn about new or outside-the-box loan products. And so we have our specialist, Dax Tobin, here with Millennium Lending. How you doing, Dax?
Great, thank you.
Thank you for being with us, and he will be our educator for the day. How about that?
All right, let's do it.
Well, how long you been in the industry, Dax? Although I kind of know we've been working together
So I've been
forever.
doing loans in Las Vegas for 22 years.
Wow.
Yeah,
Okay, so that makes you 45?
something like that.
I've been working with Dax for quite some time, and we've done a lot of. We've taken care of a lot of investors, and we've seen the results from that, and it feels really good to help people make some money here.
That's right.
Right? All right, so today's topic is DSCR loans. And I know it's a hot topic out there, so let's get back to the basics. Let's start with what does a DSCR loan stand for?
Debt service coverage ratio.
Okay, and should I ask for a definition of what that means?
Sure, it really just means that the debt you're going to cover the debt on the loan with your rent. So the idea is that some percentage of the payment is going to cover, or some percentage of the rent that you're going to receive, or the lease you're going to receive on the property is going to cover the mortgage payment, typically the principal, interest, taxes, insurance, and any HOA that is associated with the property. And that ratio is what's going to drive the terms of the loan. Typically, they want it to be 1-to-1. So if your rent is going to be, your mortgage payment is going to be $2,000, they want the rent to be at least $2,000.
That's going to be one of my next questions.
Yeah.
So, great explanation. And I guess I would elaborate by saying, or not elaborate, but we'll revisit what you just said by saying that you qualify based on the investment property and rent versus your personal financials, right?
And that's really the hallmark of the program, is that for people who don't necessarily want to use their personal finances, can't use their personal finances, or don't want to be bothered with all that extra paperwork, this program is really ideal for them, because the qualifications really are just mostly based on the property itself. It works a lot more like a commercial loan does than a typical residential loan.
So it works similar to a commercial loan. You qualify based on the investment property and the income it brings in.
Correct.
Does the investor still have to qualify based on, do you even have to see their personal financials, and do you need to run their credit score?
Yeah. So it's similar in that regard, but there are elements of it that are also residential in nature. They do pull a personal credit report, and your assets do matter. They have to be sourced and seasoned assets, and the personal credit report does matter, and it will appear on your personal credit.
I'm glad you answered that, because there is a major misconception in the world for people a little familiar with these loans, that you do not have to provide or qualify personally at all.
Yeah, well, so there are all different flavors of loans out there, and once you get into this realm of non-qualified mortgage loans, people can make their own rules for what they want them to look like. It's not a homogenized guideline set like Fannie Mae or Freddie Mac or FHA. So in theory, somebody could make a guideline, a set of guidelines, and call it a DSCR loan that may be different than what I'm talking about. But all the investors that I've seen and the ones I use have those guidelines.
Good. So they don't have to adhere with FHA. I mean, not FHA. Fannie Mae, Freddie Mac, and FHA, you said.
Correct. They're not. They
have their own
basics
guidelines.
Of what the guidelines may fall back to those in lieu of anything that doesn't override from their perspective their guidelines. So they'll fall back to something, their big set of guidelines, if there isn't anything that in their guidelines that don't address it. But the guidelines in general don't really have anything to do with the Fannie Mae, Freddie Mac guidelines.
Okay, great. Because a lot of this conversation is not only explaining the product, but also myth busting, right?
Yeah.
And knocking down all the misconceptions, and there's many. And so I think a lot of people out there are thinking, or I've been told by a lot of people, which is incorrect, that you don't have to qualify at all on a personal level. And basically anyone can go and get this loan as long as they have the down payment based on the rental property, which is inaccurate. You need to qualify to a certain extent personally as well.
On the programs that I've seen that I'm using, absolutely.
Yeah. All right. Well, Mythbuster number one. So,
and usually that's not the issue for most people. Usually have assets that they can use, and people who are buying the properties have a good enough credit score that it's not an issue.
But personal income is not a major factor. It's just something that I guess would be a thing looked at.
Yeah, I'm using these products mainly for people who might be self-employed and they have complex businesses. They may have 4 or 5, 6 different businesses. Some are losing money, some are making money. They don't show properly on there. They haven't filed the return this year. They're on extensions, and going through all that to qualify them to buy a $500,000 investment property is just onerous, and they would much rather just use this program.
So here's a big question: true or false? This program does not fall on a personal credit report or get recorded on a personal credit report. It does. Okay, all right. So that's a huge misconception there as well, is that I've been even told that it will not show up in your credit report. Another misconception. Okay, all right. So why then, I know you hit a couple points, but why would an investor want to use this loan then?
Primarily for the income side of things, because it's usually used primarily for self-employed people or people who don't want to show their income, and they want the property they're purchasing to stand on its own merits. And really
So you're not using a person's DTI, debt to income ratio.
It doesn't exist. It's not calculated. There's no income report.
That's where that misconception comes from, for sure.
Yeah. And so they think that, there are 3 different main qualifications for any residential loan. It's your income, your assets, and your credit. So they're just eliminating the income side of it for these.
Okay.
The assets and the credit portion still apply. Now, exactly what you need relative to other programs may be slightly different, but in general, the income portion is the part that is just not calculated, it's not disclosed, and the income is replaced by the income of the property itself relative to the mortgage to make sure that the income that the property can qualify. You're replacing a person with a property.
Is there a limit to how much of these loans an investor can have?
No, in most cases they don't care how many properties.
And so, speaking about past clients, together we've serviced some investors that kind of capped out on your conventional
That's
products.
another reason why somebody may want it. They may have too many properties for Fannie Mae or Freddie Mac, for example, because the Fannie Mae and Freddie Mac are generally interested in, individual properties. Somebody may have too many for that, and they back away from financing those.
Yeah, and so, personal experience from us, actually, we have multiple clients, and some happen to be dentists where, they have the funds and they want to leverage, and we've seen them get capped at about 10 conventional loans investment.
Correct.
Yeah, and so this would correct that issue.
Correct.
Yeah, so that's another reason why this makes sense for some people. So what are the positives then? It's verified off the investment property. There's no real limitation on how much of these loans you can get. It can certainly be used as a bridge product as well to get investment property and then figure out the financials later on that.
True, but you have to be careful. Most of the time, there is a prepayment penalty associated with these products.
Good to know.
Yeah, you usually choose between 1, 2, and 3 years prepayment penalty. Not that you can't buy out of the prepayment penalty; it's not that severe, but it's in order to get terms that most people are satisfied with. You end up with a prepayment penalty.
So prepayment penalty just simply means that within that term of the prepayment penalty, you have to pay a fee to sell or basically eliminate that loan.
Correct.
All right. So those are some of the positive. What are some of the negatives behind this loan then?
Well, the interest rate is going to be a little bit higher than it would otherwise be if you documented all of your income.
I've been seeing about a point higher.
It really depends on the overall terms. If you have a high credit score, if you're putting, a significant amount of money down, so if you're putting down, say, 35-40% down, if you have a high credit score, if you take a prepayment penalty, say 2, perhaps 3 years, you can mitigate a lot of that difference. So, and it depends on the market as well. A year or 2 years ago, there was a larger difference between full documentation loan in this regard and what there is now. And some of the people who were the investors in this marketplace are getting very aggressive with these DSCR loans now. I think that's why we're hearing a little bit more about them. And I've seen where that difference can be as little as 3/8 of a point now, or half a point, and that's worth it for people. Who are looking at this and deciding that they want to buy this property, and they don't want to go through all that, either don't want to or can't go through all that, all those qualifications.
What's the minimum down payment?
Well, the minimum down payment is going to be driven by the rent versus the payment numbers. So, you're looking at 25%, but, that it's not a hard and fast number, because if the 25% number doesn't get you the ratio of payment to lease that you're looking for, the payment versus the lease that you're looking for, you're going to need to put down more money.
Well, that's a good way. See, you're looking at it from the lending perspective, and I look at it from the real estate land. Hey, we got to find a different price point of a property that gives more rent, right?
Yeah. So, I closed a DSCR loan where the value on the property was very high. It was a great purchase. The team did the buyer and the real estate agent did a great job, and they were able to put down 30% on that property, for example, and they still had a positive debt service coverage ratio. They got a great rate, and it's wonderful. I've seen other properties where they have to put down 40+% in order to achieve the ratio that they need to make that happen. So,
to me,
to
me that becomes property specific.
Yeah, it's property specific.
Or if you look at it in reverse, wallet specific, because we find out what a investor's max down payment is or what their budget is, if so, so we can fit the real estate based on that down payment amount and the rent that comes in.
Finding an efficient house, or efficient,
basically
property.
Trying to make the numbers work to a break even or positive cash flow. That's the goal usually. So here's a myth, potentially a myth, and you can bust it or not. The property has to be a positive cash flow.
It doesn't have to be. There are DSCR programs that will allow for a ratio that is less than 1%. So,
what does less than 1% mean?
So it's the payment is $2,000, but so you're purchasing the property. Now, these can be used for refinances as well. Keep that in mind. So,
I did not know that.
They can be. Yeah. So you have a tenant in the property, for example, and you don't owe anything on it. You want to do a cash out refinance, and you want to put a loan on the property, and you have a tenant in the property. You can do that as well.
Okay.
So it's not just for purchasing, or you want to just you want to refinance the loan that's on the property. So you have a $2,000 a month lease on the property, and you want to get and the mortgage is $2,100. That is a DSCR loan that there is a product for. Now,
so define the 1%. What does 1% mean?
1% means it's just a 1% ratio. $2,000, $2,000.
1 to 1.
1 to 1.
Okay,
1%.
so you're just so vocabulary wise, his 1% means 1 to 1 ratios, guys. So rent to mortgage payment.
So let's use $1,000 as just for numbers. So if you then had $1,000 payment, and then you had a $900 lease, then you would have a 0.9% ratio. So clearly that's not ideal, right? Because you're losing $100 a month. So that is, there are DSCR products that allow for that, but then at that point your terms are not going to be nearly as good as if you were positive cash flow. And then there's all kinds of different sliding scales. There's 1 to 1. There's, if you go above 105%, you get better terms, 110, 150.
So the higher the risk, the worse the cash flow, the higher the risk, the higher the interest rate. And
Everything in lending is based on risk.
Right.
So if there's less risk to the lender, the terms get better.
So DSCR Mythbuster number 2, the investment does not have to be a positive cash flow.
No.
Right. All right.
Now,
So
will you be happy with the terms, and will you want to do the loan? No.
well, it was a yes/no question.
Yeah.
So there's no. But all right. So let's say what this tells me is that the investors doing this type of product are very confident that rents are pretty stabilized and probably will increase in the future and not the other way around if they're calculating off today's rent.
It's a good analysis.
Well, that plus a down payment, but the reason that they would take this risk is they're confident that the current rent is sustainable in the future.
Yeah, because the principal and interest portion of it is being locked in.
Right. But they're not predicting that rents are going down. If not, it would be a high risk loan.
Yes, because they'd be going the opposite direction. Correct.
All right.
Yeah.
So, looking at the big picture on the why, that is why investors I think are confident doing these loans is that they're predicting or hypothesizing that rents are going to continue to be the same or go up.
Yeah.
General picture, right?
Yeah.
All right. We already went over some of the negatives. Is that interest rates might be higher. Any other negatives? I took some notes here. Strict rental income requirements. We just talked about that. Larger down payments. We just talked about that. Higher fees and prepayment penalties. We talked about that. Based on risk. Not ideal for negative cash flow properties. We talked about that. Limited lender availability. So not all lenders offer it.
Yeah. There's not a lot of, big downsides to this loan. Those are really it. You may have to put down more money than you otherwise would for, to get a similar cash flow positive situation because you end up with a slightly higher rate or a prepayment penalty to offset that. So, to the extent that you can document all of your income in a way that you're satisfied with through that process, it's not necessary to use these, but, for somebody who this fact pattern fits, it's an amazing loan.
So I'm going to give our investors a quick tip on this loan, being that we've experienced some challenges finding the properties that matches the proposed down payment from the investor.
Yeah.
For example, investor has X amount of down payment and wants to do 25% at whatever the number is. Based on that budget, we're looking for what they want in that budget. So say it's 400,000, we're looking for 400,000-ish homes, and we are struggling to make those numbers work, for example. And at that point, a lot of realtors call it quits because they simply can't find investment property that fits that means within a area that is comfortable to the investor. So understanding the lending side of things, here's the quick tip and a solution to that. That same investor that could not find properties based on that ratio, 25% down in specific areas, can go down in price point and now apply more down payment based on that ratio, right? And so if they have $50,000, it goes further with a less of a purchase price, making it a higher down payment. And so to give you an actual real life example, someone looking at a $500,000 property, 25% down, and based on the high interest rates today, we couldn't make the cash flows that were comfortable for the investor work. We said, hey, how about we take the purchase price down by 50%, $250,000, and now they're putting 50% down with the same amount of down payment budget, and now those numbers work.
Yeah, finding an efficient purchase price and down payment combination relative to the amount of rent you can get and the payment is always critical. When you're doing these investment properties, fixing in on a specific dollar figure that you want to spend on the property isn't always the best way to go about it.
It is not, especially with these high interest rates.
Yeah.
It's like forcing a circle peg in a square hole.
Yeah.
Or vice versa, right?
Somebody comes to market and they say, I have a certain amount of money to spend on an investment property. And they go out and immediately just start looking at homes or condos or townhomes or whatever it is at that price, as opposed to finding the best way to maximize their investment dollars with the amount of money they have available to them. And it could be chopping it up into 2 different properties or, some other combination of them.
Right. But it changes the down payment ratio with the same budget, and that's the trick right there.
And having a higher down payment, for example, and can get them more efficient terms on 2 different properties, or one property for now, and then waiting another 6 months buying another property, and they end up with a better overall investment portfolio that way, than trying to eke out smaller down payments on larger properties.
You just need professionals assisting you that can think outside the box. Because a lot of people call it quits. Here's the budget, here's the down payment, I can't find a product that fits it.
Yeah, and that's where the consultation and going through all that, seeing what's out there in the market, understanding what you can get in total amount of rent at that price range versus a lower price range, and finding that efficiencies in those marketplaces in the neighborhood you're looking for and all that. And
that's just keeping an open mind and working outside the box. And another, we'll call it a brain fart that investors come in with, is like, I have X amount because of that's what I have in my pocket, or I have X amount, we're talking about down payment, because that's what I have from a 1031 exchange, and I have to use it all because I don't want to pay taxes. And based on that, they're taking that number and looking at the minimum down payment, or 25%, to maximize the type of property they buy, rather than keeping an open mind to find a product that best suits that on a budget.
There are very few instances in this market right now that I would say that 25% is the correct amount to put down on an investment property.
It's hard, and I know it from a user end. Like, we're searching for days for investors, and we use mathematic equations, basically an ROI calculator, including mortgage terms, to figure out investment properties, and it is not easy.
So finding a way to get that number up to at least 30 really makes a big difference. And
well, let me clarify. It's not easy based on the preferred areas that the lenders are choosing. Because you can be careful, investors. Don't just buy something because it fits the mathematics. Remember, real estate starts with location. So don't just accept, just the mathematics without understanding everything else that's correlated with real estate. All right. Well, that's a nice epiphany there. What else do we have? Is there any other questions that you get about these type loans?
No, I think they're simple loans. So, just finding the right time to utilize them in the right environments with the right clients, and but they're not over simple like some people think. Like some of the misconceptions that you say people have about them, that just because they're going to do this type of loan, they don't need to qualify for anything, or they don't need assets, or it doesn't matter what their credit score is, or any of these other things. And there still are qualifications. It's just, it eliminates one big factor, which is personal income, which is a large roadblock for people. And there are some other benefits to it. Oh, one big benefit that I forgot to mention is you can close in the name of an LLC, which you cannot do. Like Fannie Mae, Freddie Mac, FHA
That's
will
huge.
not lend to a company.
So how does that work? So the person that's buying would have to apply based on as a person, or can they apply with their LLC?
Yeah, so the way you have to qualify the LLC, there are very distinct guidelines for how to go about that. It's beyond the scope of this conversation to describe the guidelines.
Yeah, we just want
how it works. But I will say
simple.
that if somebody does want to close and purchase the property in the name of a company, an LLC, which many investors do, it can be done with these programs.
And that's critical sometimes for a 1031 exchange.
Absolutely, but it has to be done properly. It can't be done. You need to make sure that you consult with your lender about the guidelines specific to this product, and how to make sure that it adheres to those guidelines for it. But it can be done. There's one of the primary benefits of this program that a lot of people love as well.
Cool. Well, that's not a myth, but that's a great point and tip. Quick fact that you can close in the name of an LLC, limited liability company. Pretty cool to know. I did not know that.
Yeah.
What else do we have today about DSCR loans?
We talked about short-term rentals, being able to, when you can use,
Let's talk about short-term rentals.
Yeah.
So, most of the investors that we talk to, we're crunching numbers and talking about longer term rentals, meaning 1-year terms with a regular property management company like us that we service. This can also qualify with short-term rentals or daily rentals even, to my understanding. People utilizing the VRBO, Airbnb, or even whatever it is, daily rentals though, right?
Yeah, so it gets tricky when you start to use short-term rentals. So if you have a history of short-term rentals over a longer time period, they can be analyzed and they can be used to provide the rental portion of whatever your lease is. But by their very nature, they are variable and they're not going to be as solid as somebody who's paying the rent every single month and it's the exact same dollar figure. So that's why they need a longer term history of them, and you need proof of them. They need to be filed on tax returns. The tax returns don't come into play. They need to show a history of the proof of those coming in, because you don't want to show your tax returns.
So what might work is that if the investment is already run as a short-term rental and has the paper trail of steady income.
Yeah. So I will say that they can be used in that regard, but if you're purchasing the property and you want to use the projected rents or lease from that property, it's far easier simply to just get an appraisal done on it. And along with that appraisal comes a little mini appraisal that talks about the projected rental income from that property from a long-term lease. 99 times out of 100, there's no reason not to just use that projected income as opposed to whatever the VRBO schedule was for the last year. Because the only time you would need to use that would be if that far exceeds what the rental income from the long-term lease would be on the appraisal that is being done. So if they were averaging $5,000 a month in the VRBO and a long-term lease will only be getting $3,000 a month, and they wanted to be able to use that extra $2,000 a month to somehow qualify for this DSCR program because their payment was $5,000 a month, that's where something like that would be necessary. Or if they were doing a refinance, same thing. But that would be used to be able to get something, I would say, that far exceeds what a long-term lease would get you, because you can always prove a long-term lease through a projected long-term lease through the appraisal.
Okay, well,
so it's uncommon to have to go to that extent on these properties.
Well, first of all, to clarify a couple things with our investors is that short-term rentals, daily rentals here in Las Vegas is uncommon in general. And the reason behind that is that it's very hard to obtain a permit in order to qualify a home for daily rental, which is required from the state. So it's not as easy as it sounds on paper or on podcasts, whatever you're learning about. I have many investors that call about daily rental until they find out how hard it is to acquire one, or when you find one, the prices are inflated because a lot of people are looking for that specific product. And here's a hint to the daily rentals is that the number one issue beyond just getting a permit for it is the HOAs and homeowners associations. And the majority of homeowners associations, I would say 99% of them, do not allow short-term rentals. And so that's your roadblock. It's permitting any.
So the way people may be confused about the way you go about qualifying if you're going to purchase a property. Let's say you're going to go purchase a property, it's vacant. And so, well, how do we establish what the rent is? That's how it's established. So if you're going to go, let's just say you're going to purchase a property, the proposed payment on that property is, call it $3,000 a month. When you get the appraisal done for that loan, you get a regular appraisal to establish the value of the property. And then you also get an additional little mini appraisal that is done that usually has an additional 3 homes in it that have the rental schedules of what the rents for rent comps for properties in that area and how much the comparable rents are. And so they may say, okay, homes similar to this are renting for $3,000 a month on average in this area. And then the underwriter will take that $3,000 and use that as the projected rent for that property, and that's how you calculate the DSCR ratio. It doesn't need to be rented. There doesn't need to be any history there. That's how it works. If there is a tenant in there, and let's say they are paying that property and you can prove a 3-month history of that, you can use the $3,100. It has to be reasonable. It can't be, oh, they've been paying me $6,000 a month. We're going to use that. That starts to become a problem.
Yeah.
But if it's a reasonable amount of rent that exceeds what is on the renting schedule by a reasonable figure, and you can prove a track record of that, and there is somebody in there, you can use that in lieu of the rent and comp schedule.
Okay, well, This is great information. I don't want to go down the rabbit hole of all these crazy one-off questions.
That's an example. So people get confused by, well, how do I know how that works? And that's an important part of a piece of all that.
I think this whole conversation is important because not only do people want to know more about this product, investors, but there's a lot of bad information out there. I've seen Instagram reels and the podcasts of people stating facts or stating things that are not fact. And we just myth busted that. Like, it does not go on your credit report, for example. So that's why you're here. We're bringing some real factual information to the world, and we appreciate your wisdom.
Now, with like I mentioned at the beginning, with any of these loan programs, as soon as you have something that a lender can make up their own guidelines and decide how they want to lend money to any individual for any reason, they can decide how they want to do any of those things. Any one particular lender can decide that any of the things that I've discussed for a typical DSCR loan, they can say, well, we're going to do it differently than that. We're not going to report our loan to the credit agencies.
So disclosure, I guess. Disclosure.
So all the ones I work with, the major they do. But anyone could decide that any one of these common guidelines could be different, and that could be their market niche.
So I will send a disclosure to the world that this is just based on Dax's experience and by typical DSCR loans that you see.
Yep.
All right.
Marketplace right now.
And there could be different scenarios, right?
Yeah.
All right. Disclosure's out there.
Okay.
All right. You're taken care of. Well, I think we don't have to extend this meeting longer than it needs to go because we got a lot of good information out there, and we don't want to overwhelm everyone. But if you guys want to know more, reach out to myself, reach out to Dax. We'll put our information at the end of this podcast. And again, thank you for joining us, because by you joining us lets us know that we are adding value to you guys, which is why we continue doing these podcasts. So again, thank you for joining us. Thank you, Dax. You guys have a great day and go invest wisely. Take care.